investor eyes this week were on the Federal Reserve and its decision on interest rates. And again, the Fed has decided to postpone any moves. In this morning's U.S. Bank Economic 360, U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman and Business Courier publisher Jamie Smith sort out what it all means. Gentlemen.
Thanks, Peg. Mike, thanks for being here.
Good morning.
So tell me, why are the Feds at the center of attention?
Yeah, well, it seems they always are recently. We have to remember that interest rates are at essentially zero and have been for a number of years. The Fed put that in place back during the financial crisis to try to stave off a larger financial crisis. But here we are 7 years later, and interest rates are still at zero. So many have been wondering, when exactly is the Fed going to get off of the sidelines and start moving interest rates higher again? So, you know, it certainly has been the center of attention. I mean, the Fed changing direction after this multi-year policy of low interest rates, that's going to have a big ripple effect.
Yeah. Well, what does that mean to Cincinnati business? You know, what does it mean? How long is it going to stay?
Right. Well, you know, when we think about the Fed, generally we think about Wall Street and the ramifications there. Investors get nervous that higher rates could prove difficult for the stock market. In fact, we've already seen some of that so far this year. Bond investors worry that higher rates would be headwinds for their investments. But it goes beyond Wall Street. It affects Main Street as well. So on the positive side of the ledger, if you're a saver, you're well aware of what the rates being paid now on savings accounts and money market funds. So the Fed pushing rates higher, that's going to mean more earnings on your savings. So that's a good thing. The flip side of that coin, though, is that if you're a borrower, rates are going to be going higher on car loans, mortgages, you name it. So if you're borrowing, you're going to be paying more. So again, we have to focus. Yeah, it matters to Wall Street, but it matters to just about everyone in some form or fashion.
So what's that mean going forward? Do we keep doing what we're doing? Do we get conservative? Do we get bullish? You know.
Yeah, well, that's the big mystery right now. So, you know, the Fed is on record as saying they don't want to raise rates until they're confident that higher rates won't disrupt the economy. What exactly that point is, though, is left sort of ambiguous. So many observers think that we're at that point now. In fact, many would say we've been at that point for some time now. So the expectation was rates might be higher this time last year. And when that didn't happen, then earlier this year. And then when that didn't happen, in August, and then last month, or then last week. So, you know, it's a guessing game right now. The Fed doesn't meet again until December. They're getting a lot of pushback that they haven't moved so far. So we're starting to hear that December will finally be
so whether it be December, January, or June, you're going to be back on, and we're going to be talking about those effects, right?
Yeah.
All right, great. Well, thanks for being here today, and we'll look forward to picking your brain on this again.
Thanks, Jamie.
Thanks.